June 2025, a day of market panic, political drama and billionaire beef. Trump and Musk go to war. Europe slashes interest rates and London, it's bleeding companies. Let's break it all down, starting with the controversy that shook the US. Before we get to the Musk drama, you need to understand what kicked it off. One big beautiful bill. That's what President Trump is calling his new economic package. But what's actually in it? In short, massive tax cuts, massive new spending. The bill slashes corporate tax rates again down to 17%. It promises tax relief for middle-income families, and it funnels trillions into infrastructure, military, and manufacturing subsidies. It's being called the biggest federal spend in US history outside of wartime. But here's the catch. No real plan to pay for it. No new revenue, no cuts elsewhere. Economists warn it's like stepping on the gas with no brake. That brings us to Elon Musk. Musk blasted the bill publicly. He called it reckless, saying it could trigger a debt crisis within 2 years. Trump never wanted to take criticism, quietly threatened to cut all federal contracts with Musk's company, Tesla, SpaceX, Starlink. Boom. Tesla stock immediately tumbled 14%. The broader market followed. S&P 500 down 0.5%. Dow down 0.3%. Nasdaq down 0.8%. Investors are now spooked. Why? Because if personal grudges can cancel billion-dollar contract, no one is safe. Companies relying on federal money, or even indirectly, could face higher borrowing costs, higher insurance premiums, less investor confidence. This is about more than Musk. It's about policy risk infecting the private sector, and that's dangerous. While Washington melts down, Europe is quietly panicking too. On June 5th, the European Central Bank cut interest rates for the 8th time in a year. New rates go into effect June 11th. Deposit 2%. Refinancing 2.15%, lending 2.4%. Why the cuts? Because inflation in the eurozone fell to 1.9% in April, lower than expected but not without consequences. The ECB now forecasts 2% inflation in 2025, 1.6% in 2026, 2% again in 2027. Lower energy prices and a stronger euro means cheaper imports and possibly even deflation. Plus, global trade tensions, especially the US tariff on EU goods, are dragging down exports and investments. Growth is sluggish, 0.9% GDP expected this year. So what's the ECB trying to do? Get consumers borrowing, spending, and stimulate demand. But if they overdo it, inflation could bounce back hard. So future rate cuts, the ECB says they'll be slower and more cautious. Meanwhile, in London, another red flag. UK Fintech giant Wise just announced it's moving its primary stock listing to New York. It'll keep a secondary listing in London, but the message is clear. The US is more attractive than London. More investors, more liquidity, bigger valuations. But Wise isn't the only one. 88 companies left the UK markets last year. Only 18 joined. Even Indivior and Cobalt Holdings are heading to the US. If this keeps up, London risks losing its reputation as a financial hub. And while Wise may get more visibility in the US, it's also diving into a hyper-competitive space with titans like PayPal and even Nvidia muscling into fintech. So yes, this move may help Wise grow, but it also exposes how vulnerable the UK market has become. Let's recap. The US is unraveling in a storm of ego and fiscal chaos. Europe is cutting rates and praying it doesn't overshoot. And the UK is hemorrhaging companies to more lucrative markets. If current trends hold, Washington could see more CEOs pushed out by politics. The ECB could face inflation whiplash. And London might go from global finance giant to a regional player. The next few months will be crucial. Will governments act or react? Let us know what you think in the comments. Which of these stories is the biggest threat to economic stability? And if you want more of these breakdowns of what's happening around the world, subscribe to this channel. We're tracking the money and the power plays.